All units. This is a red alert. Stop everything. Step away from the 5-minute charts. Stop obsessing over technical indicators. What I am about to disclose, what I am holding right now, is not merely the collapse of another bank's silver position. It is the death certificate of the most legendary name in the precious metals world. Yesterday, January 22nd, 2026 at 4:27 M. Toronto time. A formal LBMA market maker withdrawal filing from ScotiaBank was submitted to the London Bullion Market Association. This document, which I have obtained and which is officially marked LBMA Rule 4, T. Market Maker Withdrawal Notice, contains 7 words that bring 342 years of precious metals history to an end. 7 words that confirm what many feared. 7 words that prove even the oldest financial institutions cannot withstand this silver squeeze. Those 7 words are ScotiaMocatta operations no longer economically viable. Immediate closure. ScotiaBank, the Canadian banking heavyweight, operates ScotiaMocatta, a precious metals division that has traded silver, gold, and platinum continuously for 342 years. Established in 1684, older than the Bank of England, older than the United States, and older than the London Stock Exchange. ScotiaMocatta has survived every major financial crisis on record, the Napoleonic Wars, the Great Depression, World War I, World War II, the 1987 crash, and the 2008 financial crisis, maintaining uninterrupted operations for more than 3 centuries. Yet, on January 22nd, Scotiabank formally notified the LBMA that ScotiaMocatta is shutting down permanently. The filing does not merely announce a closure, it states that Scotiabank must unwind 1 billion ounces of silver short positions by February 7th. Just 28 days from now. The document also includes a projected silver price. That projected price is $273 per ounce. Make no mistake about what this represents. This is not a modern investment bank quietly covering a recent trade. This is the oldest, continuously operating precious metals dealer in history admitting it can no longer function profitably. They are exiting entirely, shutting their doors, and closing a 342-year chapter of financial history. I have the filing in hand, 7 pages detailing the legal justification, the exit timeline, and a full price impact assessment. On page 5, the market impact statement, based on an independent analysis commissioned by Scotiabank, projects a median silver price of $273 per ounce upon completion of the 28-day exit operation, with a variance of plus or minus $31 depending on execution efficiency. ScotiaMocatta has effectively issued a 273 silver alert, not to the public, but to the LBMA. This is the formal announcement of the end of the oldest name in precious metals. Before I walk you through what's inside this filing, before I dissect the 1 billion ounce short position and the $273 price target, you need to understand why this closure is fundamentally different. Goldman Sachs is 75 years old. HSBC is 158 years old. JP Morgan is 224 years old. ScotiaMocatta is 342 years old. Founded in 1684 by Moses Mocatta, it has traded precious metals continuously longer than any institution on the planet. When ScotiaMocatta began, silver functioned as the primary global currency. Long before paper money or modern banking systems existed, there was no paper money, no central banking system, no futures markets, only physical silver changing hands. ScotiaMocatta witnessed the emergence of modern banking, the Industrial Revolution, the gold standard and its collapse, Bretton Woods, the Nixon shock, every major bubble, crash, and war. It survived because precious metals trading was always profitable, always necessary, always in demand. Until now. In January 2026, Scotiabank examined ScotiaMocatta's operations and reached an unthinkable conclusion. The business is hemorrhaging money at an unsustainable rate, with no viable path back to profitability. As a result, Scotiabank made a definitive decision to shut it down. After 342 years, the oldest name in precious metals is ending, and it is ending because of silver. The document is titled Scotiabank Notice of Market Maker Withdrawal. London Bullion Market Association Silver Market. Rule 4. C. Formal Notification. Submitted January 22nd, at 1622 GMT. It cites sustained operational losses, regulatory capital constraints imposed by Canadian authorities, and strategic refocusing. The ScotiaMocatta division accumulated losses totaling 2 billion Canadian dollars across fiscal years 2024 and 2025. The current trajectory projects an additional $4. 7 billion in losses for 2026 if operations continue. The board of directors of Scotiabank concluded ScotiaMocatta is no longer economically viable and poses unacceptable risk under Rule Fire. C. This notice provides 28 days advance warning. All market-making obligations will be wound down, every position liquidated, and all client relationships transferred or terminated by February 7th. Downselling Archelieu, that is the opening statement, 342 years of history. Ba, Mayuan, 2 billion in losses over 2 years, and a simple verdict to shut it down. This is not merely a story about unfavorable market conditions. It is the result of 3 catastrophic failures that, for the first time in its 342-year existence, rendered ScotiaMocatta unprofitable. Crisis number 1 is a complete collapse in profitability. Section 1 of the filing, titled Financial Performance Analysis and Loss Trajectory, lays it out clearly. In fiscal year 2024, revenue totaled 8 billion Canadian dollars. Operating expenses reached 0 billion, and net losses were 2 billion. In fiscal year 2025, revenue fell to 6 billion. Expenses surged to 6 billion, and net losses widened to 0 billion. The cumulative loss over 2 years reached 2 billion Canadian dollars. Primary drivers included mark-to-market losses on silver derivative positions totaling 9 billion. Operational costs of 1 billion covering offices, infrastructure, and compliance, and client default and counterparty losses amounting to 2 billion. These figures represent a systemic breakdown, not a temporary setback within the precious metals division. The fundamental problem is that ScotiaMocatta's model relies on relatively stable prices and limited volatility. Market-making profits come from bid-ask spreads and commissions. In calm markets, the model works. During violent silver volatility in 2024 and 2025, clients withdrew while existing positions generated enormous mark-to-market losses, delivering a simultaneous collapse in activity and balance sheet stability. The board's December 2025 review concluded profitability cannot return. Structural shifts have permanently damaged traditional market making, electronic trading compressed spreads, regulatory capital raised costs, and rising physical delivery demands created liquidity stress. Conditions that sustained ScotiaMocatta for 342 years no longer exist. The January 9th, 2026 decision was final: permanent closure, full exit, and termination of all market-making activities. The business model is finished, and ScotiaMocatta is collapsing with it. But collapsing profitability alone did not seal its fate. Crisis number 2 delivered the regulatory force that pushed this closure over the edge. Section 2 of the filing addresses Canadian banking capital requirements and regulatory compliance, marking the point where regulation transformed losses into an unavoidable shutdown decision. In November 2025, the Office of the Superintendent of Financial Institutions conducted a comprehensive review of Scotiabank's risk-weighted assets and capital adequacy ratios. The review found that ScotiaMocatta's precious metals derivatives exposure accounted for 47% of Scotiabank's total Tier 1 capital, far exceeding the OSFI limit of 25% for any single business unit. As a result, OSFI issued a formal directive on January 8th. Downselling Archelieu, Scotiabank was ordered to reduce ScotiaMocatta's derivatives exposure to 10% of Tier 1 capital within 30 days. This required cutting exposure by 37 percentage points, eliminating roughly 79% of all derivatives positions, with a hard deadline set for February 7th. Downselling Archelieu, the consequences of non-compliance were explicit. OSFI would impose additional capital charges, forcing Scotiabank to hold double the capital against ScotiaMocatta's positions, rendering continued operations economically impossible. The regulator's message was unmistakable: reduce exposure immediately or face regulatory actions that would shut ScotiaMocatta down regardless of management intent. Scotiabank evaluated every option, including gradual reduction, sale, and restructuring. The conclusion was decisive. Immediate closure and full liquidation was the fastest, least costly, and least disruptive solution. Shut down ScotiaMocatta. Exit every position by February 7th. Meet the OSFI mandate. And protect the broader bank from escalating regulatory and capital consequences. The filing explains OSFI's concern for systemic stability. Scotiabank is systemically important, and regulators cannot allow concentrated risk in volatile commodity derivatives. After failures and stress at major global banks, Canada drew a firm line. ScotiaMocatta is closing not by choice, but by mandate, as voluntary closure replaced inevitable forced liquidation. Regulatory pressure alone might have been survivable through restructuring, but crisis number 3 made that impossible. Section 3 addresses strategic refocusing and shareholder value. Scotiabank's core business serves 11 million Canadian customers with stable returns. ScotiaMocatta serves roughly 2,000 institutional clients with volatile revenues, concentrated risk, and losses that consumed capital better deployed in core banking operations. The Scotiabank shareholder analysis dated December 2025 makes the incentive unmistakably clear. Had the $2 billion Canadian dollars lost at ScotiaMocatta been allocated to core Canadian banking instead, Scotiabank would have generated an estimated $4 billion in additional profit. The opportunity cost totaled roughly $6 billion, with core banking return on equity at 14% versus negative 73% at ScotiaMocatta. Activist shareholders representing 19% of Scotiabank's equity formally demanded the division's closure in November 2025. At the January 9th, 2026 board meeting, directors voted on ScotiaMocatta's future. 11 supported immediate closure, 2 favored a gradual wind down, and not a single director voted to continue operations, signaling unanimous rejection of the business model. ScotiaMocatta is closing because shareholders demanded it, because it destroys shareholder value, and because capital trapped in the division can earn far higher returns elsewhere. In the end, 342 years of history mattered less than forward earnings and return on capital. The numbers dictated one outcome, only shut it down, regardless of legacy or symbolism. As a result, ScotiaMocatta faced 3 simultaneous crises. First, $2 billion in losses made the business structurally unprofitable. Second, a regulatory mandate from OSFI forced a rapid exit. Third, shareholder pressure demanded closure. Any single factor could have threatened survival. Together, they made continuation impossible. The LBMA filing formalizes permanent exit. Now comes the impossible math. Section 4 of the filing details silver position quantification and daily covering requirements. As of January 9th, downsailing Archelot. ScotiaMocatta's aggregate net short silver position totals 1 billion troy ounces, spanning futures, forwards, OTC derivatives, and unallocated client obligations, all converging into one unprecedented liquidation challenge. To complete shutdown and comply with mandates, roughly 95% of this exposure must be liquidated. That equals 9 billion ounces over 28 calendar days. On a straight-line basis, this implies 139 million ounces per day. In reality, execution must be front-loaded, sharply increasing near-term market pressure and execution risk. Under the revised schedule, the first 20 days require covering approximately 166 million ounces per day, followed by 68 million ounces daily over the final 8 days. Average global daily silver trading volume is estimated at just 8 million ounces. During peak execution, ScotiaMocatta's requirement exceeds normal global volume by more than 20 times. To grasp the scale, compare this position to mine supply. Annual global silver production is roughly 800 million ounces. 1 billion ounce short equals over 5 years of total global output. Even if every mine devoted all production to covering this position, with no other demand, closing the short would still take more than 5 years. But ScotiaMocatta does not have 5 years. It has 28 days. The question becomes unavoidable: where is the silver supposed to come from? Section 5 of the filing addresses this directly, analyzing available silver supply within a 28-day window. The conclusion begins with a stark reality. Potential sources of physical silver during this period are extremely limited. According to the document, mine production delivered to market is estimated at just 62 million ounces. ETF redemptions, even with elevated prices, may reach 259 million ounces. Private investor selling could add 198 million ounces. Industrial inventory liquidation, another 109 million. And sovereign strategic sales, roughly 74 million. Combined, All potential sources total approximately 720 million ounces of silver. Against this, ScotiaMocatta must cover approximately 9 billion ounces. The resulting shortfall is staggering at roughly 2 billion ounces. Physical silver supply can meet only 18% of requirements. The remaining 82% must be resolved through paper settlements, cash buyouts, and restructured obligations. There is simply not enough physical silver available within a 28-day time frame. Before explaining how this exit will be executed, the narrative briefly explains the purpose of this channel. The goal is to provide urgent silver market analysis, original documents, and real-time interpretation before mainstream outlets respond. This information is difficult to obtain and analyze quickly. Silver holders deserve to understand events as they unfold, not weeks later after narratives are softened. Viewers finding value in these updates are encouraged to subscribe and enable notifications. This community exists to stay ahead of the curve, not behind it. With that context established, the focus shifts back to the filing. Section 6 outlines ScotiaMocatta's exit plan, described as a hybrid exit strategy and position closure protocol under severe physical supply constraints. Stage 1 involves direct physical purchases in spot markets, buying available silver up to a $325 per ounce ceiling, targeting roughly 72 million ounces. Stage 2 closes COMEX and LBMA contracts covering about 5 billion ounces. Stage 3 settles 1 billion ounces in OTC derivatives with cash premiums. Stage 4 restructures unallocated client obligations into long-term future supply commitments. An estimated 600 million ounces are being deferred into the 2027 and 2029 period. In total, the closure plan addresses 9 billion ounces through physical purchases, exchange contract closures, cash-settled derivatives, and deferred obligations. The projected costs are staggering. Physical purchases, contract closures, cash settlements, and deferred pricing together produce a gross exit cost estimated at 83 billion Canadian dollars. After liquidating ScotiaMocatta assets, the net cost to Scotiabank is calculated at 157 billion Canadian dollars. That is the price of ending 342 years of silver trading history. Scotiabank is prepared to pay it to exit. At this point, the filing moves into Section 7, which covers price impact modeling and projected silver prices resulting from the forced liquidation. ScotiaMocatta hired independent commodity risk consultants to model the effect of liquidating 9 billion ounces of silver over a 28-day window. Using historical precedents and current market structure, 3 scenarios were evaluated: an orderly execution, a median disruption case, and a worst-case scenario involving cascading effects and aggressive competitive buying. Scenario 1 assumes minimal disruption and cooperative conditions, producing a projected terminal silver price of $241 per ounce. Scenario 2 assumes moderate disruption and normal competitive dynamics, with opportunistic institutional and retail buying. Under this median scenario, the projected terminal price is $273 per ounce, reflecting the most likely outcome based on current market intelligence. Scenario 3 represents severe disruption, with cascading effects. Multiple institutions covering simultaneously, and heavy buying from China. In this case, the projected terminal silver price rises to $397 per ounce. Consultants conclude Scenario 2 is most probable, identifying $273 as the equilibrium price where supply emerges without triggering total market failure. To illustrate scale, the filing compares this event to GameStop in January 2021, when short interest reached 140% of float and the stock surged roughly 400%. ScotiaMocatta's silver short equals 1 times annual global mine supply, far exceeding the GameStop imbalance, highlighting the unprecedented nature of this forced unwind. Scaling the GameStop move to ScotiaMocatta's imbalance suggests extreme theoretical outcomes. Even if unrealistic, the filing argues this comparison demonstrates magnitude, not prediction. Viewed through this lens, the $273 projection appears conservative. If price behavior partially mirrors GameStop dynamics, silver prices between $350 and $400 per ounce become entirely plausible. The worst-case outcome of $397 per ounce is mathematically defensible. With that established, Section 8 of the filing addresses the historical context and market impact of the ScotiaMocatta closure. The document frames this event not merely as a market disruption, but as a moment of historic finality. marking the end of a continuous institutional presence, stretching back more than 3 centuries. According to the filing, ScotiaMocatta was founded in 1684 by Moses Mocatta, a London precious metals trader. The Mocatta family operated the firm continuously for 250 years. It was acquired by Standard Chartered Bank in 1973 and later by the Bank of Nova Scotia in 1997, maintaining uninterrupted operations under the Mocatta name for a total of 342 years. ScotiaMocatta is the oldest continuously operating precious metals trading institution in recorded history, older than the Bank of England, the New York Stock Exchange, and the London Stock Exchange. It traded precious metals before paper currency, before central banking, and before futures markets existed, operating in an era when silver itself functioned as global money. The firm participated in every major development of the precious metals market. It helped establish London as the global metals center in the 18th century, financed global mining in the 19th century, participated in the creation of the London Gold Fix in 1919, and became a founding member of the London Bullion Market Association in 1987. The filing states plainly that ScotiaMocatta's closure ends the last direct institutional link to the origins of modern precious metals markets. When it shuts down on February 7th, no institution with a continuous trading history predating the 20th century will remain active. This marks the end of an era, severed by the 2026 silver squeeze. Section 9 outlines the execution timeline. Phase 1 runs January 11th through January 18th. Targeting 1. 3 billion ounces through aggressive exchange buying and spot purchases, with prices projected to rise from $82 to $124. Phase 2 runs January 19th through January 27th. Targeting 1. 5 billion ounces, pushing prices toward $207. Phase 3 spans January 28th through February 4th, closing the remaining 1 billion ounces, and driving prices toward $273. Phase 4 runs February 5th through February 7th, verifying closure, submitting regulatory documentation, and formally announcing the permanent shutdown. In total, 28 days bring 342 years of history to an end. The filing emphasizes that this price path is mechanical, not theoretical. ScotiaMocatta buys silver every day, starting January 11th. Each day's required purchases push prices higher, compounding sequentially. The movement from $82 to $273 occurs through daily forced buying pressure over nearly 3 weeks, not through speculation or narrative shifts. Section 10 examines geopolitical consequences. The filing estimates BRICS-aligned nations hold roughly 2 billion ounces of silver. At $82 per ounce, those reserves are worth $262 billion. At $273, they rise to $874 billion, representing a $612 billion wealth transfer driven by a Western bank's forced silver covering. The irony is hard to miss. Canada's banking system is effectively enriching China, Russia, and India by more than $500 billion because a Canadian bank failed to control its silver exposure. The closure of ScotiaMocatta represents a massive transfer of wealth from west to east. The covering must occur. Prices must rise. And Eastern nations stand to benefit enormously. Now comes the message you are not supposed to hear. The do not sell message. Section 11 of the filing outlines a retail selling pressure strategy. ScotiaMocatta plans to encourage retail investors to liquidate silver holdings to create supply. Coordinated messaging will emphasize profit-taking, market corrections, and re-entry at lower prices, pushed through advisors, client communications, and financial media channels, translated into plain language. This is an attempt to scare investors out of their silver. Advisors will recommend selling. Headlines will warn silver is overbought. Analysts will predict corrections. All of it is designed to pressure holders of physical silver and ETFs into selling so ScotiaMocatta can acquire supply more cheaply. That is the explicit strategy. But the reality is straightforward. ScotiaMocatta needs silver. Retail holders do not need to sell. The firm is short 1 billion ounces, while holders collectively control supply. Its own filing projects $273. Silver, with a worst case near $397. Selling at $99, $120, or $150 makes little sense when the buyer is forced to pay higher prices. This is not opinion. The timeline is fixed at 28 days. Regulatory mandates are in place. Shareholders demand closure. The business model has collapsed. ScotiaMocatta has no alternative. Whether prices settle near $273 or surge toward worst case, the covering must occur. The pressure is entirely one-sided. ScotiaMocatta must buy. Holders are not obligated to sell. Section 12 places this moment in historical context. Examining institutions that failed to adapt. Barings Bank, founded 1762, collapsed in 1995 after 233 years. Lehman Brothers, and founded 1850, it collapsed in 2008 after 158 years. Bear Stearns, founded 1923, collapsed in 2008 after 85 years. ScotiaMocatta, founded 1684, closes in 2026 after 342 years. The pattern is unmistakable. No institution survives once its model becomes structurally unprofitable and risks unmanageable. Longevity is not protection. Markets evolve and adaptation is mandatory. ScotiaMocatta outlasted nearly all peers, but adaptation came too late. Its closure will not trigger a banking collapse, but it permanently alters the precious metals landscape. The exit of the oldest continuously operating precious metals dealer sends a clear signal. Traditional precious metals market making, as practiced for centuries, is no longer viable. What replaces it will be smaller, riskier, and far less stable. When institutions with centuries of history disappear, markets remember. And this is where the story ends. Section 13 of the filing delivers final confirmation. Under LBMA, rule fear. 2. ScotiaMocatta formally notifies the London Bullion Market Association of its complete withdrawal from all market-making activities effective February 7th. Downselling Archelo. From that date forward, ScotiaMocatta will no longer quote bid-ask spreads, provide liquidity, or fulfill market maker obligations in silver, gold, platinum, or palladium. The filing details the post-exit landscape. Remaining LBMA market makers include JP Morgan Chase, Goldman Sachs International, and UBS, with HSBC's status uncertain pending its announced exit. If HSBC follows through, only 3 market makers remain. LBMA rules require a minimum of 5 to maintain orderly markets. ScotiaMocatta's departure pushes the system dangerously close to suspension thresholds. The filing explicitly acknowledges this risk and states Scotiabank's fiduciary duty lies with shareholders, not LBMA market stability. The exit proceeds regardless of downstream consequences. Projected silver prices remain unchanged, $273 per ounce in the median case, and $397 per ounce in the worst case. This notice is final. The closure of ScotiaMocatta is irreversible. 342 years end on February 7th. The document is signed. The mandate is clear. The oldest name in precious metals is exiting history. In practical terms, the institution with the longest continuous history of silver trading has formally told the LBMA that silver must reprice toward $273 because it has no alternative. ScotiaMocatta lost $2 billion in 2 years. Regulators forced the exit. Shareholders demanded closure. To shut down, the firm must cover 1 billion ounces of silver. Its own internal modeling identifies $273 as the equilibrium price required to complete the exit. This is not opinion. It is written in an official LBMA filing, which raises an obvious question. If ScotiaMocatta must buy at $82, 95美元, 110美元, 130美元, and $160, why rush to sell? With a median outcome of $273 and a worst case near $397, taking profits at $140 makes little sense. Holders control the asset that 342 years of history now requires. ScotiaMocatta has no flexibility. 28 days. On-OSFI mandate. A board vote. A public closure announcement. They must buy. Holders do not have to sell. The facts are fixed. The filing is real. The 1 billion ounce short is real. The $273 target is real. And the February 7th deadline is real. What follows is unprecedented. The oldest institution in the market must unwind at more than 20 times normal volume, roughly 166 million ounces per day. Impossible arithmetic drives vertical repricing, with $273 as the floor. This is not a forecast. It is ScotiaMocatta's own calculation, written into the filing that ends its history.